Pro golfer Phil Mickelson was recently caught up in an insider trading scandal, and that had us wondering, what exactly is insider trading and how can you get caught? Morgan Stanley financial advisor Larry Palmer is here to talk to us about the best ways to avoid trouble when investing your hard-earned cash. So we want to welcome you back to the show.
Good morning.
We know that insider trading is something that can get investors in some real trouble, but what is it really?
Well, first of all, insider trading is a very complex area of the security laws. In its simplest form at the core, insider trading occurs when a person is in possession of what we call material non-public information.
Okay.
And they either tip that information or they act to trade to profit on that information.
Okay.
Now, material non-public information is defined essentially as information that would have been widely disseminated to all investors so they have a fair chance to make an intelligent investment. Could be merger and acquisition news, good earnings report, bad earnings report, product liability, or even a new drug from a biotech company. So as a context of that and construct of that law, there's something called tipper-tippee liability. So if I call you up, Amy, and I say, hey, look, I know this company is going to get taken over. I don't trade the stock, but I tell you. You call up your broker and you act on it to try and profit. Not only are you in trouble because you traded on inside information, but I'm in trouble because I tipped you. Both are illegal.
But what if you were to tip me off, but I didn't know it was illegal? What if you just tell me, hey, I heard some great news, this is going to make some good money. I still get in trouble even though I didn't know it was illegal?
It is possible. And what happens is the SEC has something called subpoena power, and they check phone records and golf club records and all kinds of records, and they can basically figure out and put a chain together and figure out what happened.
Okay, so
it's very serious.
Yeah, what are the most important things we should look out for when we are investing to make sure we don't get caught up in this?
Great question. Think about this. When you're investing your life savings or your 401k, or you sell a piece of property and you get a large pool of liquidity, first of all, take your time.
Okay.
There's nothing that's so urgent that you have to invest in right now that's going to be material to your net worth in the long term. Number two, do due diligence on your financial institution and your advisor.
Okay.
There's so many great institutions in this country. Some are large, some are small. One of the things about the money business is we're heavily regulated.
Okay.
So I would check the financial institution, find out who's regulating that institution. If you're with a small institution and you're not sure if they're reputable or not, and you can't find any government entities that regulate them, you might want to rethink putting your money there.
Okay.
Secondly, with your financial advisor, hiring a financial advisor is a highly personal and custom decision. It's an important one. Because think about it, you're talking about things that you don't even talk about at the dinner table, which is your money. Ask for references.
Okay.
Do your due diligence. And the number one thing I would ask a financial advisor is, what do you do with your money and how do you invest your own money? Because that will tell you where you fit within their investment philosophy.
Okay. What about, a lot of times you hear about these get-rich-quick investments. How do you separate the fact from fiction?
That's a great question. I think it's the classic example of if it's too good to be true, it probably is, specifically in the investment world.
Okay.
So what are we trained to think? When someone says, hey, Amy, I've got an investment opportunity, the first thing that goes through your mind is, how much money can I make? What's the average annual return I'm going to get on my money? Well, I think there's a couple other questions that are deeper than that you should ask. Number one is, what's risk? Do I have the possibility of losing all of my capital in this investment? Now, if you tell me the investment's going to average 8% a year, for example, I put my money in the investment, how much volatility am I going to have while I'm sitting in that investment in order to get this 8% over here? And the last thing, and I think we learned this in 2008, how do you get your money out? The more illiquid an investment is, probably the fewer people should be investing in it. There's more risk in it.
Okay.
So it's something to think about.
And this is all great advice. Anything else that we should be thinking about when we're thinking about investing some money?
Yeah, I think common sense, follow your gut. Sometimes the best investments you make are the ones you don't make. And you don't make them because you asked a lot of questions. Questions are the answer. Ask lots of questions. Follow your gut. And I think the last thing that I could say to help the viewers, define what risk is for you. Is risk the possibility that you're going to lose money, or is it going to bother you that you were offered an investment opportunity and you decided not to invest and it went up 20% and you didn't participate? Which one of those bothers you more? That'll dictate probably what your investment style is.
Okay, wow. And here I was just thinking it was all about buying a lottery ticket. This is perfect information. Thank you so much, Larry Palmer. We appreciate it.